When we think about a mortgage, we usually just think of it as a loan, right? A big one. But it's so much more than that. It's really a financial journey that millions and millions of us take. And all those journeys together, they shape one of the biggest markets on the entire planet. So today, let's pull back the curtain on this massive financial engine and see exactly what makes it tick. To really get a sense of the scale we're talking about here, let's just start with one number, a truly massive number. The total value of all the homes in the United States is hovering around $49 trillion. That is the giant landscape this whole system is built on. But this isn't just about giant abstract numbers. That $49 trillion market is built on something deeply personal, the dream of owning a home. For generations, it's been a cornerstone of what we think of as personal security and economic stability. And that dream is so powerful because it's not just one thing, is it? It's the security of just having a place to call your own, for sure, but it's also about things like potential tax breaks, that feeling of pride and accomplishment, locking in your housing costs against rising rents, and of course, the chance to build real wealth over time. These are the big motivators that kickstart the entire mortgage journey for so many people. Okay, so you've decided you're going to go for that dream. Well, your very first step is what you could call a financial audition. Before any lender is going to hand over that kind of money, you've got to prove that you're a good bet. And that's where the industry's tried and true 4 C's of lending come into play. So how does a lender really weigh the risk of giving you hundreds of thousands of dollars? Well, it all boils down to these 4 key pillars that have been the bedrock of good lending for a very, very long time. First up, we've got character. And no, this isn't about your personality. Think of this more like your financial report card, your credit report, your FICO score. Lenders look at all of it to answer one simple question. Have you been a reliable borrower in the past? It's all about your track record and your willingness to pay. Then there's capacity. This is all about your financial firepower right now. A lender needs to know you actually have the ability to pay them back month after month. They're going to look at your income, how stable your job is, and compare that to the debt you already have. They need to see if your budget can handle this new big payment without, completely breaking. The third C is capital. This is basically your financial safety net. What do you have saved up? Any investments? It shows a lender that you have a cushion to fall back on if things go wrong, and it also proves you've been able to manage your money well over time. And finally, the fourth C, collateral. This one is the lender's ultimate insurance policy. For a mortgage, the collateral is the house itself. It's simple. If, for whatever reason, you don't pay your loan, the lender has a legal right to that property to get their money back. Okay, so you've passed the 4 C's audition. Awesome. Now the real work begins. The next stage in a mortgage's life is the approval process, which, let's be honest, can feel like a total gauntlet. This whole journey really follows 5 key phases. It all starts with origination. That's when the loan is first created. Then it moves to processing, where a whole file is built with all your financial documents. After that comes the really crucial step, underwriting. That's the deep dive risk analysis. And if you get through that, you're on to closing to sign all the paperwork. And finally, funding, which is when the money actually changes hands and the house is yours. Now, of all those steps, underwriting is the big one. It's the moment of truth. This is where a professional risk analyst goes through every single detail of your application with a fine-tooth comb, your credit, your income, the property's value, to give that final, official yes or no. It's the ultimate green light. So once you're approved, congratulations, you have to understand the price. The cost of a mortgage isn't just a loan amount. It's really determined by the interest rate, which can be nudged up or down by something called points. So what in the world is a discount point? Well, the easiest way to think about it is like prepaid interest. You pay a fee at closing, 1 point is equal to 1% of your loan amount, and in exchange for that upfront cash, the lender gives you a lower interest rate for the entire life of the loan. So this leaves every borrower with a classic trade-off. You can take what's called a par loan. That means no points at whatever the current market rate is. Your upfront costs will be lower, but your monthly payment will be higher. Or you can pay for points to get a below-market rate. That'll cost you more on closing day, but it will save you money every single month for years and years to come. All right, let's zoom way out for a minute. Your individual mortgage doesn't exist in a little bubble. It lives and breathes in a world of massive economic cycles, shaped by the most fundamental forces out there, supply and demand. So on one side of the equation, you have supply. And there are all kinds of things that can limit the number of homes available. Things like the rising cost of land and construction materials, tax policies, and a big one, local government rules like zoning, which can make it really hard to build new homes. And then on the other side of that equation, you have demand. The number one driver here by far is job growth. More jobs mean more people needing a place to live. But it's also affected by things like how easy it is to get a loan. When credit is loose, more people can buy, and even government tax policies that encourage homeownership. Now, when these giant forces of supply and demand push and pull against each other, they create these powerful economic cycles. And we have all lived through some really dramatic ones lately. Remember the early 2000s? Super loose credit standards fueled a massive housing boom. It felt like prices would just go up forever. But of course, that bubble burst, which led directly to the Great Recession. And ever since then, the market's been in the slow, gradual recovery, really defined by much, much stricter lending standards. What all this shows is that the mortgage journey is always changing, always being shaped by these huge economic forces. And it really leaves us with a critical question as we look to the future. In an economy that is constantly shifting, how will the very idea of homeownership and the financial journey to get there evolve for the next generation?